you need to pay close attention. You need to remember, find out ways to remember it. So let's look at the formula. The first formula that we'll talk about. Today we'll talk about cash conversion cycle. Okay, then after that we have more things to look at here. So first, this is the one that you need to see. So CCC, which is cash conversion cycle, which also means days inventory outstanding. Days inventory outstanding plus days receivable outstanding minus days payable outstanding. Okay, this is the formula. This could also be written as this. This is first. Second, it could be written like this. CCC equals to operating cycle minus days payable outstanding. So what is operating cycle? Operating cycle is basically days inventory outstanding plus days receivable outstanding. Okay, there are a lot of names to it also, so it could be written as this also, based on the first one. Okay, inventory period plus receivable period minus payable period. So this is also another way to write it. Period, outstanding, all these are different names to it. All right. And of course, the most expanded version, which is this. So some students, they don't want to find inventory period. They don't want to find days inventory outstanding and blah, blah, blah. First, straight away, you can use this most complete, most expanded version, which is average inventory divided by COGS over 365 plus average receivable divided by net sales over 365 close bracket, close big bracket, and minus average payable divided by COGS over 365. Okay, this last formula is the most complete formula. It's the expanded version. Okay, so if they're given you the inventory, receivable, net sales, COGS, you can say every count of CCC. All right, but question could be giving you periods, giving you turnover, and etc. So these are the four same formula, okay, for cash conversion cycle. All right, without wasting much time on the formula, this is already one shot. I show you the formula here, all four different ways, some different terms being used here. So let's move on to the first calculation question here. So let's look at the question together. Salem Incorporation has an inventory turnover. You see, the question, they tell you different things. They give you inventory turnover. Inventory turnover of 15. Account receivable turnover of 9. And lastly, account payable period of 51 days. What is the length of the cash cycle? So they want you to find the CCC. So this question, they give you turnover, and the period. All right. So give you period easy lah. You can see period already done, but you don't have inventory period and receivable period. They give you the turnover instead. So in this case, this CCC, the formula that you could use is inventory period plus account receivable period minus account payable period. This is given to you. But inventory and account receivable not given. So you need to calculate. To count inventory period, they only give you turnover. So that means 1 year inventory turnover is 15 times. 1 year, 15 times turnover. Account receivable, 1 year, 9 times. So how many days for each turnover to happen? So the count inventory turnover inventory period with the turnover is 365 divided by 15. Inventory turnover. Account period, account receivable period, it's 365 divided by 9 times 1 year. So how many days per turnover? Account payable period is given to you, 51 days. So now you can count how many days for a full cash cycle. 13.89 days. So what does 13.89 days means? Means for your cash to come into you, you take an average of 13.89 days. Or if you round up means 14 days. Every 14 days, you manage to convert cash in your account. Okay? So this is what we call the cash conversion cycle. It takes a full 14 days to convert your credited money into cash. All right. So far, any questions? Again, as usual, if you have any questions, please voice down in the inbox. All right, in the chat box. So if no one voicing out, I will proceed on. Okay, I'll proceed. So let me know if you have any difficulty understanding or you're lost so far. All right. So this is one of the methods. You see, you can use turnover to count inventory period and account receivable period. So I already show it to you. I already explained to you the meaning of it also. Okay. So this, yeah. So until now, still need to ask me is standard wise. It's definitely gonna be uploaded. Okay. So it's gonna be uploaded. So you can go and check it out on YouTube. All right. So coming on to question 2 now. Okay. A firm has an inventory turnover rate. This question, they tell you turnover rate. Inventory turnover rate is 16. Receivable turnover rate, it's 21. And lastly, payable turnover rate, it's 11. So they ask you operating cycle. Not cash cycle, huh? They want operating cycle. So what is operating cycle? Operating cycle is inventory period plus account receivable period. So very simple, straightforward. They give you turnover, you can count. So 365 divided by 16 plus 365 divided by 21. This one not needed because you're counting operating cycle, not cash cycle. So it's 40.19 days. 40.19 days. Okay, very easy. All right. So the next question here, question 3, it's something which resembles much more of an exam question. So if exam questions to ask, this will be something like this. It will be more like similar to this. So consider the following financial statement information for the Bulldog ISA corporations. Calculate the operating and cash cycle. You need to find the operating, you need to find the cash cycle. How do you interpret your answers? All right. So information given to you here, inventory. Why 11 we discard again? What 11? You're not using it. The formula only want you to find operating cycle. So you no need to use the account payable turnover rate. So what is the, yeah. So basically the turnover rate of account payable is not in the formula or not part of the questions that you are needed. So that number is not needed for you to calculate the operating cycle. You only use the account payable if you want to count the cash cycle conversion, the CCC. So the question is asking us about operating cycle, means they only want to find operating cycle. Operating cycle formula is inventory period and account receivable period. So the account payable turnover rate is not being used. So I did not say discount. It's not being used only. Okay, it's not being used for that particular question. So depending on what question asks you. All right. Clear? Satish, cannot. Okay. So question 3. Question 3, you see, they are beginning and ending. So I explain to you what does it mean. So inventory, they give you beginning of 17,385. Ending, they give you 19,108. So account receivable, also the same thing. They give you beginning and ending. 13,182, 13,973. Account payable, also the same thing. 15,385, 16,676. Net sales, okay. Sales, they never give you any beginning and ending, so it's only one number. Cost of goods sold, COGS, 140,382. Okay, so when they're giving you a beginning and the ending, means you need to find the average of these both. Add up, divided by 2 to get the average inventory. Add up and get the average receivable and average payable. So information given to you for this question are all raw figures. Inventory at the beginning, inventory at the ending. Okay, they never give you any average, never give you any turnover, they never give you any ratios here. So it's all raw data here. So with all this raw data, you need to find the operating and the cash cycle. So as you all know, the operating cycle is days inventory, or inventory period plus receivable period. The CCC means minus payable period. So you need to find inventory period, receivable period, and your payable period. Okay? All right. So some students want it to be simple. They say they will use this expanded version. CCC equals to average inventory divided by COGS divide 365. You can key in one by one like that. Okay. So let's do with the all one first. If you wanted to use CCC equals to average inventory. Average inventory means 17,385 plus 19,108 divided by 2. Then divide by COGS 140,382 divide 365. Plus account receivable, average account receivable 13,182, 13,973 divided by 2 divided by net sales 178,312 divided 365. So make sure you key in the calculator correctly. This is the challenge here. If you do one time, one shot. And lastly, minus account payable period. So average account payable period is 15,385, 16,676 divided by 2 over COGS 140,382 divide 365. Okay, so you'll get your answer. All right, you get your answer. If you want to be safe, then you count one by one. This is CCC. So operating cycle means you take these two only. This give you operating cycle, the whole thing give you CCC. So if you want to be safe, you can do one by one. First, you find your inventory turnover first. Okay, inventory turnover is COGS divided by average inventory. Okay, means 140,382 divided by 17,385 plus 19,108. Then your average inventory is 7.6936 times. Next, you count your inventory period. which is equals to 365 over turnover. So 365 divided by 7.6936, you get 47.44 days. Then the next one, you find account receivable turnover. Okay? Account receivable turnover, it's sales divided by average account receivable. Sales is given to you 178,312 divided by this one you divide by 2. I forgot. Average. Okay? Average account receivable here 13182 plus 13973 divided by 2 first. So average receivable, average account receivable turnover. So account receivable turnover here, you get 13.1329 times. So now you can find your average receivable, your account receivable period, AR period. 365 divided by the turnover. 365 divided by 13.1329. You get 27.79 days. So with these two, you can get your operating cycle. So operating cycle will be 47.44 plus 27.79. Okay, so operating cycle will give you 75.23 days. This is the first one you need to find. All right, not complete yet. You need to do your cash cycle. So number 5, account payable turnover. Okay, account payable turnover, COGS divided by average account payable. COGS is 140,382. Average account payable 15385 plus 16676 divided by 2. Get 8.7572 times. And lastly, you can find your account payable period. 365 divided by the turnover. 365 divided by 8.7572. You can get your account payable period. 41.68 days. So to find CCC, is operating cycle minus account payable period. The answer you get is 33.55 days. So you need 33.55 days average to receive back your cash in your account. Okay? So this outcome, it's supposed to be similar to the outcome you use this full conclusion. So this one short one, CCC, will give you 33.55 days or so. That including you use your calculator correctly. Okay. I received several emails from students saying that, sir, I cannot follow, my calculator cannot get the figure as shown in the class and so on and so forth. Then I realized, first of all, the problem is when you key in the figure, please make sure you key in the correct figure. Okay. Number 2, please make sure you know how to use your calculator. So the one I show you in the class is based on your Texas instrument. So if you're using another version of financial calculator, then you better go and read your calculator manual to find out how do you want to key in or how do you want to use some of the function on your calculator, which I could not help you. Okay, there are so many financial calculator out there. It's impossible for me to master every one of it. I could only show the common one, which is recommended by university, the TI instruments. Okay, I don't use that calculator personally, but that is a recommended one from the school. Then the example will be based on that calculator. So if you are using other calculator, Dell, HP, Casio, Sharp, or whatsoever, find out how to use it. If the way I show you in the class, you could not get the final answer. This could most likely be your key-in issue, the input issue. Number 2, settings. So that's why you need to read how to do the settings for your calculator. Don't just buy it, discard the box, throw away the manual, and just use it. So I couldn't help you if you do that. All right. Okay. So those who have already discarded the manual, what I can tell you, you can always Google it, YouTube it. Definitely, there's somebody there that already do a review or a way to calculate it. Okay. So back to our question. Anyone have any issues with question number 3 so far? So this step 1 to 6 is basically the breakdown of this whole equation. I'm doing it one by one. Okay, to make it easier, to make students easy to see. All right. If you're confident, you want to plot everything into this equation to find your CCC, can. But don't forget, they want this question one operating cycle and also cash conversion cycle. So don't think that you completed CCC, you need to do OC. So you still need to do your OC. Okay. So I still don't see any questions. Anyone have any issues? Come, before I move on to the next question. All good. Very good. Okay, fantastic. Very good. All right. So we are done with cash conversion cycle now. The following question, it's also a very favorable question in the exam. It's called capital budgeting. Okay. Not really capital budgeting, it's more towards cash credit sales budgeting. All right. So this question is a bit complicated because they give you a lot of information. So let's look through it together. Question number 4 here. So question number 4, information given to you. Here are some important figures from the budget of Wexter Enterprises for the second quarter of 2013. Okay. So they given you April, May, and June. All right. So first is sales. Credit sales, 411,000. May, 368,000. June, 432,000. Next, credit purchases. Don't think that I'm reading you the table, then it's not important. So listen to me carefully. Later I'll tell you how or what is going on here. 293,800 and 307,400. This is credit purchases. Next one is cash disbursement, including wages, taxes, and expenses. Okay, so different one have different expenses, different wages, and different taxes. 76,500 and 84,900. Next is interest. All same, 8,200. And lastly, equipment purchase. Buying equipments. 27,500, 24,000, and 46,900. Okay, so let's read the next part. The company predicts that 2% of its credit sales will never be collected. That means out of 411,000, 2% cannot get back, bad debt. Okay, 45% of its sales will be collected in the month. So 45% of 411,000 will be collected on April. You'll get the money on April. And the balance 53 will be collected following month, which is on May. Okay. So credit purchases will be paid in the month following. So these credit purchases, April 250,000 is going to be paid on May. May 293 will be paid on June. This one will be paid on July. So you pay on the following month. So read this statement carefully. This will change. This is where you need to do the changes and find out your cash sales budgeting. Okay. In March 2013, so March is not here. So now they're telling you March info. In March 2013, credit sales were 387. Credit purchases 279,500. Ending cash balance. Ending cash balance of 97,500. So ending cash balance of the month will be a starting cash balance on the following month. So this 97,000 will be bring forward to April. Okay, 97,500. Then you need to count. This one will shift over to here. And this one will be shift over to here. And this one shift to July. Okay. So prepare a cash budget for April, May, and June. They only want a cash budget for April, May, and June. For 3 months only. March no need, July no need. So how do we start this? Very easy. First of all, count what is the net sales for each month. So just now, we know March credit sales is $387,000. So this is separated into 3 sections. 2%, which is bad debt. 2% of 387 is 7740. This is bad debt. Ignore. 45% will be on March. 174,150 March. 53% is going to be on April. Repeat this for April, May, and June. So April is 411,000. 2% bad debt, 8220. 45%, 184,950. This is going to be April month itself. Okay, and then the balance will be on the following month, which is on May. Okay, repeat for May. May credit sales, 368,000. %2 bad debt, 7360. 45% on the same month payment, 165,600 May. Balance 53%, 195,040 on June. Last month, June, 432,000. 2% bad debt again, 8640 bad debt. 45% on the month of June, 194,400. Balance 53 on July, 228,960. Okay, so the question tell you to do a credit, okay, a cash budget sales. Prepare a cash budget for April, May, and June. April, May, and June means things related to April, May, and June you take into consideration. March 1, not April, May, and June. So April, May, May, June. July, not within our budget, we don't care. March, not within the budget, we don't care. So April, May, and June, these are the information we want to need. Then now, we can start doing our cash budget on the second quarter. Cash budget Q2 2013. You need to do for April, May, and June. Starting off with beginning cash balance. So just now you know the March cash balance will bring to April, right? So that one retain 97,500. Next is your cash collection. This one come from where? Your credit sales. So April collection is how much? April collections. Look at April. So April, you will get your March balance and the month of April itself. So total these two together. 205,110 plus 184,950. So you get 390,060. So this is the amount of cash you receive on April. 390,060. $390,060. So total up. Total cash inflow here, 487,560. Next, you need to minus cash outflow. So cash outflow here will be cash payment. Cash payment from credit purchases. So April cash payment will be paying off the March one. Look back here. Okay, these purchases will be paid on April. This one on May, this one on June, this one on July. We don't care. So you need to pay your March credit purchases. So put your March credit expenses here, 279,500. Then the rest all taken from the month of April itself. What are the rest of the things? Wages, cash disbursement. Wages here, 82,300. Interest, same, 8,200. Same for everybody also. Okay. This one same for everybody. You just copy back only. Copy back from the information given to you at initial chart. 76,500, 84,900. Okay. And of course, this one, the cash payment is the following month also. So this one, May, you are paying April 1. June, you are paying May. And July pay June. August pay July, and so on and so forth. So they only want you to do April, May, and June. Anything else you ignore. All right. Next is equipment purchases. This one also for the same month, no changes. So copy back 27,500, 24,000, and 46,900. So now, you total all this together, total cash outflow, add all this. This one, the top one, don't add first. Let me block it off. Okay, this one you don't add. All right, and all this first, 387,500, 358,900, 433,800. Then after having this, you can get your net cash inflow. Net cash, total cash minus total cash outflow, inflow minus outflow. So you get your net cash, 90,060. So this figure will be the following one starting cash balance. 90,060. Okay. Cash collection. Add up the May cash collection. 217,830 plus 165,600. So you get 383,430. So 90,000 plus 383,430. You get cash inflow 473,490. 473,490 minus 358,900. You get 114,590. So this one will be the following one, beginning cash balance, 114,590. Then find June cash collection. June, okay, June, 195,040 from May and 194,400 from June. Add up together. Add up together, cash collection for June, 389,440. 504,330 minus 433, you get balance 70,230 that they can bring forward to July. So this complete your cash budgeting. This is what they want. Okay, this question usually carry 10 to 15 marks. All right. So first of all, find the related information. Check what is the question about. Then fill in into the cash budgeting for the month that they required. So any doubt so far? Up until here? Any confusion yet? Can follow, cannot follow? Cannot? No response. Cannot also, I don't know. Okay? Can. Lucky. Some responded now. Very good. All right. So, guys, as I told you before, the policy now is teach less, learn more. TLLM. So, tutorial, we only teach you that much. And the rest all is depending on you yourself to learn more. So when you learn already, or when you go through the questions after we teach you, you have doubts, you have any questions, the later of the tutorial is where you question me. Okay, you come and ask me, okay, for whichever you're lost. All right, but that will be too late. So it's best for you to ask me now. If you don't understand, after the class ended, after the teaching done, then you have more chance to ask me later on. Then you can carry on asking me. Okay, so that's TLM, the new strategy of teaching in Taylor's now. So teach less, learn more. All right. So now mind, I'll move on to the next question here. This next question is not related to any of this anymore. It's a totally different thing now. It's talking about your economic order quantity or EOQ. Okay. So let's see what is it about. There are more formula coming in. So please be prepared to absorb it now. Okay. So look at question number 5 here. Taylor's shoes begin each period with 100 pairs of boots. Okay, these stocks, that means once this 100 boots is sold out, then they will reorder. All right, they will reorder. Every 100 boots sold out, they will replenish their stocks, they reorder. Okay, the carrying cost per pair of boots per year is $3. Carrying cost is $3 per year. What is carrying cost? Carrying cost means the inventory cost. Okay, the cost of inventory. Suppose Taylor sells 600 pair. For that year, for one whole year, the sales is 600 pairs. The restocking cost is 20. Restocking cost is $20 per order. Every time your stock finish, you reorder, it costs you $20. Okay? So, compute the following. A, they want you to count the total carrying cost. So once you see me write in blue, means this is a formula. Total carrying cost means average inventory multiplied by carrying cost per unit. Okay, average inventory times carrying cost per unit. So this could also means average inventory means divided by 2 lah. It will be separate into 2. So in this case, how much is the inventory? 100 boots. 100 boots. divided by 2 because they want average, right? 100 boots divided by 2 multiplied by carrying cost per unit $3. 50 times 3, $150. Based on this scenario, tailor shoes carrying cost or inventory cost is $150. Okay. B. Total restocking cost. Number of order per year. Okay, 1 year order how many times? Times the fixed cost per order or the restocking cost. Okay, so how to count number of order per year? The total number of sales for that year is 600. Each time you order 100. So number of order is 600 divided by 100 lah, is 6 times lah. So 1 year you reorder 6 times. Okay, so number of order per year is 6 times. 600 divided by 100. 600 total sales divided by 100 each order. So in total, you have 6 times you order in 1 year. So this is multiplied by the restocking cost of $20. So in the end, the cost of you restocking is $120. Okay, so C. C asks you how many times per year does Taylor stock? You already calculated. C, you already calculated. Okay, C is total annual sales divided by order. Okay, divided by order or reorder quantity. So 600 total annual sales divided by reorder quantity 100 6 times. Okay, 6 times. So you realize here the carrying cost, the inventory cost this company bearing is $150. The restocking cost is $120. So B is to find the total cost. Total cost means carrying cost plus restock cost. Okay, carry cost 150, restock cost 120, $270 per year. Okay, $270 per year. So E, what order size should tailor shoes place to minimize their cost? Explain your results. All right, what is the correct quantity that they should order every time? Okay, what is this EOQ? So E is talking about EOQ. E, they ask you EOQ. What is EOQ? Economic order quantity. So what is this for? So economic order quantity is basically to calculate what is the balance when you have the same carrying cost. Okay, when your carry cost equals to restock cost. So this is a balance. So you want to make sure your carry cost and your restock cost is at equal, not too much, not too low. So in this case, you can see the carrying cost is $150, which is more than the restocking cost. So this is not the optimum level. This is not the best level yet. So to count the best level, you use the EOQ. Okay, you use the EOQ. What is the formula for EOQ? EOQ is equals to square root of 2 times annual sales times cost per order divide divided by carrying cost. So this question here will be square root of 2 times 600 times 20 divided by 3. Okay, 2 times 600 times 20, 2,400 divided by 3. All right, 2,400 divided by 3. So this will give you 89.44 units. This is supposed to be the optimum level. The optimum level of each order should be 89.44 units. Then your total carrying cost will be equal to your total restocking cost. Okay, so this formula here, make sure you know to do. Okay. Do this whole thing first, then only you square root. In case you don't know. So you get now, currently in the question here, you restock every 100 times, every after 100 units sold. You restock after completed 100, every 100. So the optimum level that you should do is 89.44. After every 89.44, you replenish your stock. That will be the optimum level. Optimum level. Okay. So in this case, oops, what happened? So in this question, you realize that the carrying cost is more than your restocking cost. So means you need to reduce your order, okay? Reduce your order size, increase the number of order. That means restock more often, reduce the amount of order each time. Then you can reach equal level, and it will reduce your cost in the end. Again, when it's efficient, you can reduce your cost. All right, when it's efficient, you can reduce your cost. Okay, so any issues with question number 5 so far? It's actually very straightforward one. You just need to know the EOQ formula. When you use the EOQ formula, you find out that the optimum level of this order should be 89.44. Then you know you are over ordering. So all okay? Any problem? Average. Okay, why carrying cost is 100 divided by 2? Because they want average, They want average inventory. So when you talk about average inventory, it's always divided by 2. Starting and ending divided by 2. This is to answer Zisin's questions. Then what? What Satish reduce what? What do you mean by reduce? Reduce what? Oh, you mean the equilibrium. Okay, you see here, carrying cost is higher compared to this. 150, not the same as 120. So that means your inventory, you already order too much. So the optimum level of inventory, you're supposed to order 89.44. So that means instead of ordering 100, you order 8944. So reduce order size, increase order times. That means order more often, reduce the size. Okay, instead of ordering every 100, okay, or ordering 100 boots, now you order 89.44, but order more frequently. Again, order extra time. Can? Cannot? Okay, good. All right. So I think you guys roughly get the concept, because when you talk about the EOQ, they are trying to make your carrying cost equal. All right, 150 is not equals to 120. There's difference. So to make it the more similar they are, the lesser cost will cost to you. So you need to spend so much money. So this is the reason that you want to find the optimum point. Okay, if this 2 is not equal, that means it's not the optimal point yet. All right, let's try on question 6 to see a clearer picture. So question 6, they don't give you so much of information. They just tell you redone manufacturing using 1,700 switch assemblies per week. Okay, and the reorder, and then reorder another 1,700. So you know that the reordering is 1,700, and then it happens. The frequency of it happening is every week. So 1 year got 52 weeks. So 1 year you reorder 52 times. Okay, so the carrying cost per switch assembly is $7. And the fixed order cost, okay, this is the restocking cost. It's $725 per order. So every order, you order 725. So is Redone's inventory policy optimal? Why or why not? Is this optimal or not? Okay, so you need to find, is the carrying cost per year equals to restocking or not? Okay, if not, how? Then you use your EOQ. So let's look at this. So first of all, you need to find the total carrying cost first. Number 1, find total carrying cost. So total carrying cost is average inventory multiplied by carrying cost. Okay, so inventory is 1,007. 1,007 average means divide by 2 lah. Times with the carrying cost of $7. Okay, so 850 times 7, 5950. The total carrying cost is 5950. All right. Number 2. Total restocking cost. It's number of orders times fixed cost. So I told you 1,700 and the frequency of ordering is 52 times. So 1 year, 52 times order. Okay, so number of order is 52 times. 52 and the fixed cost per order is 725. So how much you're spending in total? 37,700. Big difference, right? Very big difference. Again, very big difference. That means this is not optimal. Okay, from here itself, you know that this inventory policy not optimal. So why? Use your EOQ. EOQ formula, square root of the whole thing, 2 times multiplied by annual sales, multiplied by cost per order, divided by carrying cost. Okay? So, square root 2 times annual sales, 52 times with 1,007, times with cost per order, divided by carrying cost of $7. Okay? So annual sales 1,007 times 52 times, right? Okay? So in the end, you get 4279.19 units. They're telling you each time you order, it should be 4,279 units, not 1,700. Because the more you order, the frequency you order, all right, okay, the more time you order, the higher the cost is going to be because it's $725 per order. So why order so often? The cost of inventory is cheaper, it's $7, okay, per unit only. So in the end, they realize that you overestimated. You order too often, which causes your cost to goes up. So in this case, okay, the optimum level of your order size should be 4,279 instead of 1,700. So what you need to do is increase the order size. Okay, instead of 1,007 become 4,279. Increase the order size, reduce reorder. Okay, reduce reorder. Can. So just now the previous question is different. Okay, the previous question, the inventory cost is expensive. So you increase your order size. Sorry, that one you sorry, the previous question one is let me see, reduce the order size and increase the number of order. So this one, you realize that you spend so much money on restocking. So they want you to reduce this number by increasing your inventory. Clear? Can you get the idea now? Okay, not okay. All of you good? Can, huh? All right. Okay, I hope that you guys managed to follow whatever is going on here. You can follow the logic. So once you get the logic right, this is no rocket science. It's actually very straightforward. Okay, if you know the logic behind this and then you understand what is it about, you know the mechanism of how it works, it wouldn't be affecting you too much.